everyone. Welcome again to our KML Foundation Table Talk vlog. I'm Paul Stamiska, your estate plan counselor, and I'm excited to be with you again this month to present another valuable topic talking about something that you maybe hadn't thought of. You know, when we meet with people and talk to them about different estate planning options, we always like to find out what their specific goals and needs are. And after that, then we can customize the right plan for them. The topic I'm talking about today is life insurance. I would imagine not many of you think of life insurance as a tool to give a charitable estate gift. But we're going to learn more today because today my guest is Chuck Worsham. Chuck is a Northwestern Mutual financial advisor and as well as a 1999 graduate of KML. So we're very happy to have Chuck here today. We look forward to the insights and the information that he can share. Welcome, Chuck.
Glad to be here. Thanks, Paul.
Chuck, I have to ask you, when people think about life insurance, I don't think they really understand what all the options are. Can you just kind of give us a general overview of how life insurance can work with charitable giving?
Sure. I always say most people will think it's protection for their family, and that is the right thought process, at least on the front end. But life insurance can be a tool used to create wealth and have a lasting guaranteed legacy. And I was also on the foundation here, and the goal of the foundation is to have an endowment. And through that, give gifts in perpetuity with a lump sum. And I think of that with life insurance, it's a way to leverage a smaller gift into a larger legacy.
That really sounds good, but can you give us some examples of how that works?
Sure. It all is based on your age and your health when you start the policies, and that's something that I always point out. But for a person, for instance, I have an example that I put together, a 50-year-old female. For a $5,000 premium, that could generate a $150,000 death benefit, assuming perfect health. And there's two options with that as it progresses. You can pay that premium for a certain number of years, stop paying that premium, and then the death benefit will either grow in perpetuity until she passes away, which is something we can be certain of, but eventually happens. And if she chooses, during her lifetime, the other option would be she can use some of that money during her lifetime that builds up in that policy in the accumulated value or cash value, and that would still leave the legacy of the death benefit if she structures it correctly, but it allows her to use some of the funds in there for herself if she needed them as well. And obviously, if you start with a younger age, another example was a 35-year-old male, perfectly healthy, could get a $200,000 permanent death benefit at only a $2,500 premium, but still carries out the same way. And you can eventually pull out more money from those policies than they even put into it from a premium standpoint, but maintain that initial death benefit of $200,000 or $150,000.
So we're talking today about life insurance as a possible charitable gift, but you're saying before someone passes away, that life insurance policy can provide extra income during their lives?
Correct. Yep. So there's three aspects that I always talk about with a true permanent life insurance policy, three guarantees. First one is the death benefit, which I always say is the most important one because it is life insurance. Second one is the premium is locked in based on your age and your health when you start the policy, and they can't change that rate on you once you're locking into it. Unlike things like car insurance or homeowners insurance where you have a claims experience, they might raise the rates. With life insurance, you're locking it in. Third guarantee is a guarantee that cash value accumulates in that policy over time. And then there's the upside based on the company you choose to work with dividends being paid, but even the guarantees guarantee that cash value will equal the initial death benefit at your age 100. And that's money that you can draw on that policy during your lifetime if you need it or want it. And you could even then draw it on the policy, give it away during your lifetime, but still have the death benefit intact for when you pass away to go to that legacy or whoever the beneficiary is.
You know, it's interesting you say that because there is a lot of uncertainty when people talk about their wealth, what they're going to have in the future, maybe retirement years, maybe as their estate when they pass away. What you're telling us is that there's a guarantee here to life insurance.
Yep, there's fundamental guarantees built into true traditional permanent life insurance policies that it's a promise from the front end and it's a promise all the way through.
And that's interesting because we do see people who want to give a charitable gift maybe to their congregation or to KML, and life happens and that money is used up before they die, and they intended to leave something as inheritance for their family or a charitable gift, and well, there just wasn't anything left. But with life insurance, there's a guarantee that will be there.
Yep, absolutely.
So it sounds like a great benefit as far as the person who really wants to leave something ultimately as a nice estate gift.
Yep.
Wonderful. So specifically, when we talk about deferred giving, I know that there are different options that people have with different tools for giving a charitable gift. Are there also different options with life insurance?
For sure. I actually think life insurance has the utmost flexibility because unlike giving that money outright to a place where you can't get it back, it gives you the flexibility to change the beneficiary. So if the person names the beneficiary as KML and then decides or for some reason wants to retract that or split that with another beneficiary, they have the right to change that beneficiary designation, and it's not something that's locked in automatically when they start the policy. You can gift the policy to the KML Foundation, for example, and in that scenario, the foundation could choose whether or not they want to cash out the policy potentially, just keep the policy in force and potentially take a reduced paid up, it's called, where they don't pay the premium anymore, but there's a death benefit there until the person passes away, and then they receive that estate into the endowment, and then that pays forward in perpetuity. But there's lots of flexibility with it ultimately.
You know, that reminds me, Chuck, we do have a donor who has actually donated the policy to KML, but then every year she gives a charitable gift to Kettle Moraine Lutheran High School, and they use that money to pay the premium. If I understand correctly, she's getting the benefit of a charitable gift up front as well as the deferred gift in the end, benefiting both ways.
Absolutely. And I'd say that's the ideal way to do it. If the person is still charitably inclined to cover that premium, even though they've already gifted that policy and changed ownership to the foundation, that's ideal from their end because they get a charitable donation that they can deduct. And then also, I always say when you go paid up on a policy, you're no longer throwing fuel on the fire, not adding, the incentive and the contributions to it. So when you're able to do that, it just enhances the growth of that policy over time, growing the death benefit and growing the ultimate legacy that's given in the future.
When we're talking about life insurance, are there any tax consequences that people have to be concerned about with those life insurance policies?
If they're not designed correctly, yes, there can certainly be some tax implications, but with a well-designed, properly set up life insurance policy, there should be no taxes, both on money that you pull out of the policy during your lifetime or the ultimate death benefit that's netted out at the end.
And let me just make note to our listeners here, that's a really good point, that a lot of times people hear something and they think, boy, that's a great idea, and they maybe pursue it without checking with their professional advisor just to make sure it's right for them. And I hear you saying the same thing, that if you've got a client, you're going to want to review that option with them before they make a final decision.
Yeah, when I sit down with people, it's based on their goals, based on what their situation is, what their financials are. And not only that, but they'd want to coordinate, and I would team up with an attorney and an accountant potentially to talk about tax implications or legal implications associated with that and coordinate with all of the rest of their affairs.
Chuck, you're an insurance agent. I'm sure you work with a lot of people on this. What if somebody doesn't have an insurance policy? What are the steps to get a policy and then how to handle that going forward?
Actually, that's one of the catches with life insurance. You have to qualify and get approved for the policy. So two things that come into play. Your age is going to be a factor on the price. The second one is your health. And then other things non-health related that can factor into the policy is things like a driving record, or if you do dangerous activities like flying a plane, things like any of those insurability things that would cause you to, mortality-wise, have a lower life expectancy. So I always tell people the best time to do it is when you're as young and as healthy as possible. But from financial reasons, not everyone can do a permanent policy right away early in their career. So a step in the right direction would be, and this is a time when you'd probably be protecting your family anyway, but to lock in a term insurance policy that has a conversion feature that will give you the right, not the obligation, but the right to convert it up until a certain age or for a certain amount of time.
As we talk about life insurance, I just want you to know that there are people in our Heritage Society that have named Kettle Moraine Lutheran High School or the KML Foundation with an insurance policy. And so it does happen and it works, except I'm going to say just about every one of them is unique in its own way. And so again, we really encourage you to talk to your financial advisor or your insurance agent to make sure that your ideas really match and fit your needs as well as the ministry that you want to support. Before we end, Chuck, do you have anything else you want to add?
Yeah, I think to your point, life insurance is what we're talking about today, but that's just one piece of the big equation of giving, and you should coordinate that with immediate gifts, coordinate that with deferred gifts, and also think about other options as far as how you can give.
Once again, everybody, thanks for tuning in. This is now our third vlog, and I have to tell you, we're surprised at how popular they become. We're really excited about sharing this with more people. So I encourage you to let your friends and family know about it as well. We're doing this, obviously, for your information, for your benefit, because remember, this is your life, it's your plan, it's your legacy. We'll see you next month.